Hi everyone, hope you're all doing well. Today we're going to go through the 4 stocks that I bought last week. So yeah, I'll spend a couple of minutes on these stocks and why I'm currently buying these stocks. And yeah, like I said, I bought these stocks last week. It was a bit more of a week of buying stocks that I haven't bought for a while. So not the usual suspects in here, I would say. So yeah, I'll go through these stocks and yeah, talk about why I bought them. As always, if you want a bit more of a deep dive, there'll be a full video on the channel. But we'll get started. And just to let you know, if you're on the Patreon, that's where I post when I'm buying and selling these companies in real time. Even though I still want to keep you guys on the YouTube with transparency of what I'm buying and selling. If you want more real-time updates, that's the place to be, as well as exclusive content. There's 2 exclusive videos a week on there. And this morning, I actually dropped my US stock portfolio review for June 2022 on there. So yeah, take a look if you want to see that extra content on there. But getting on to these stocks that I've been buying. So number 1, Google or Alphabet. I am trying to make Google Alphabet one of my large positions in my portfolio. I'd be very much happy to have it as my biggest position in my portfolio, but I am aggressively buying this one. So if it can stay down here for the next 12 months, that'd be absolutely amazing, and I will accumulate shares and I will try at least break it into the top 3 positions, potentially the number 1. We'll see what happens. So yeah, Google for me is a company with fantastic growth, fantastic profit, amazing balance sheet, such a good moat, so many products. I think it's very much still got plenty of growth to offer in the future. It's what I would say is a 5-star company, and it's not even ridiculously valued either. Like at the moment we look at Google, it's a 19 times earnings company. And when you look at the numbers that Google has done and will do, historically these sort of companies don't trade a little bit below the market averages. Normally this is a company that kind of trades at a little bit more of a premium, and as well as trading as a little bit more of a premium, when you look at the growth they're doing, it's not kind of your mid kind of single digit growth. It's very high double digit growth as well, which is fantastic. Now obviously when you talk about Google, the moat's fantastic. You're not just getting the search engine, there's loads of different parts of the company you're getting as well, and these little parts of the company as well are very interesting to watch, because these are going to be the growth drivers. But if you were to value every part of this company individually, I'd be very interested to see, because Google Cloud is a fantastic platform, growing at good rates. You've got the likes of YouTube. Obviously that's going to be growing huge still, and probably not near its prime. Waymo could be an interesting play, the autonomous driving that they have as well. So all these parts of the business are really interesting to see with Google. Such a good brand name. And on the recent earnings, a lot of the big tech's been selling off recently. Google's included in that, but Google isn't really being affected as much as the other big tech. If you look at the recent earnings, they're actually pretty strong. The growth was really good. The only kind of weak point was the YouTube side of it, and even then the YouTube side of it was actually still pretty strong. Even profit wise, they're reinvesting into the company at the moment, but if you take out the reinvestments into the company, even the profit growth was pretty strong in this business in the recent quarter. And like I said, when you look at the future growth, past growth, it's done very well. Increased revenue and profit at a really good rate, and going forward it should still grow at like 10+%, which obviously is fantastic amounts of growth, especially for a company that's over $1 trillion market cap like Google. And like I talked about earlier, the balance sheet is fantastic. There's only a slight little bit of debt on there, but they're sitting on $134 billion in cash. So you think about all the companies they could buy with that if they really wanted to. And when you're generating this amount of really good, if you look here, so nearly $74 billion a year. When you're generating nearly $74 billion a year, the opportunities you have to do that cash is insane, and you can also reward that to shareholders with buybacks and everything like that. So for me, Google is a great company to be owning, and I'm surprised not everyone's interested in it at the moment, because I think when you look at the valuation and what it offers, it's fantastic. So number 1 is Google. Number 2 is Catebox, a UK company. So this company went on a very good run through 2020, deserves it. However, what's not deserved is this drop off in the share price. Boom, lost half its value. And it's crazy to see why this has lost half its value. It doesn't trade at a ridiculous valuation. It's 14 times earnings. It holds a 3.4% dividend yield, which is a very healthy dividend as well at the moment. And Catebox basically has these stores. It also does online. It also has some smaller stores. It has stores that it has in like supermarkets, but it has some of these which you would see on the high street, and the big selling point is that they sell egg-free cakes and affordable egg-free cakes as well. So a bit of a unique selling point here, and if you ever try the products, they're actually fantastic. The recent update was really good as well. Even on a fantastic year, the company is still growing at a really good rate. So you can see here that the group expects reported revenues for the year up 50% year over year, with adjusted profit before tax in line with market expectations. And they also have been opening up more and more stores as well as increasing that online part of the business and the delivery side of it as well, which is great. When you look at the company performance, you can see the profit has really been ramping up. In the last 2 years, the profit has nearly doubled, the revenue has increased at really good rates, and even then going forward, analysts are expecting good amounts of revenue growth as well. When you look at the financial health of the company, very healthy. It does sit on 11% debt to equity, and it does sit on 5.6 million of cash. Obviously, a lot of that it does return to its shareholders through a dividend, and it's also a founder-led company who the founder does own 24% of the business as well. So yeah, I think K-Box is a company that when you look at that, it's going to grow at double-digit rates. Obviously, increase that profit. It's returning a big chunk of it down through a dividend, and at 14 times earnings, I do not think it is a bad valuation at all. So I did pick some more shares up in K-Box. The third stock is a finance company, which is Block or Square, and I cannot believe Square is now down at $57. This is one of the stocks that's fallen off massively since August time, down 78%. Now, when you look at Square's recent earnings, they weren't terrible. You look at the numbers, and I was actually very impressed with them. But unfortunately, a lot of this kind of fintech space has been massively killed off at the moment. When you look into dig into the financials, excluding the Bitcoin revenue, which is the cause of why the revenue is flat at the moment, when you exclude the Bitcoin revenue, hardware still moving in an okay direction. But the two key drivers for this company is subscription and service-based revenue, which is growing nearly double, which is fantastic. And this has fantastic gross margins. Like, I think the gross margins is like 80% on that. And that is what I'm really interested in with this business. And that is the services they offer to businesses, like accounting help and tools that help businesses as well. So that's really good to see that still ramping up. Great, that's what we want to see eventually overtaking the Bitcoin revenue in the next few years. The next one is the transaction-based revenue, which doesn't have as good gross margins, but still it's okay gross margins, and I think the Cash App is going to carry on growing massively, and obviously the Cash App helps Square come a little bit more of a mainstream name as well. So yeah, the two parts of the business which are key to the company, which obviously with the Bitcoin revenue has been in 2021 went a little bit too crazy, so that's going to have a bit of a reality check. But the key parts of the business are still growing at massive rates as well, and especially that subscription part of the business has really good gross margins, which is key. And when you look at Square, like from a valuation point of view, look how cheap it is compared to historic metrics. Total enterprise to revenue, for example, if you look at a total enterprise to EBITDA point of view as well. And when you look at the business, it's still got plenty of growth left in it as well. Square is still very much early stages. It's still got its Afterpay acquisition that it made recently to ramp up. It's also had a very new, interesting partnership with Apple, which I think will be key to watch. So yeah, I look at the valuation and look at the company still really firing on the parts of the business that I'm really interested in. And the share price has been absolutely killed, which is crazy. So yeah, I did pick up some more Square shares the other week. And this leads me to my last position that I bought a little bit more of, which was Best of the Best. Now, funny enough, Best of the Best had a really good day yesterday. So a very good time in the market. I'd like to say that I knew this was going to happen, but I did not. Best of the Best is a stock that I've owned for a little bit. Unfortunately, it got killed a little bit because the cost of advertising really did affect it. However, I still believe in this company and I'm still holding the company. And I thought, you know what, I'm actually going to nibble some shares at it. And I got a little bit of benefits from that yesterday. It trades down at 5 times earnings at the moment. On a forward basis, it will be a little bit higher, but I still think that's incredibly cheap. It does hold a 1% dividend yield, but it's just hiked its dividend up because it does generate good amounts of cash. So that is going to be a little bit higher, which is one of my reasons, is that I think the valuation is cheap, and they're also going to return a lot of cash to shareholders and hike that dividend up, which they already did yesterday, funny enough. So yeah, my theory has happened a lot quicker than what I was kind of expecting with this one. If you don't know, Best of the Best do car competitions, as well as a couple of other competitions. And yeah, they've done very well at the branding. They seem to have a lot of repeat customers as well, and have a track record of being very successful in a bit of a competitive area, which is probably my only concern with this company. Now, they did come out yesterday with a bit of a trading update, and they also had a bit of a tender offer yesterday. So the tender offer price represents a premium of 52% in the middle market closing price of £3.99% of the closing at 15th of June 2022. And like I said at the start, the company announces today that it intends to return surplus cash to shareholders by the way of a tender offer, and it was going to be approximately 11% of the company. So yeah, that was really positive to see. As well as the tender offer, they did come out with their trading update, which if we just scan down here, the revenue was in line and profit before tax was 5.40 million, which was really good amounts of cash. And the big thing is, like, when you look at 2020, this revenue is still, 2x of what it was in 2020. The profit was still 1 million ahead of where it was in 2020 as well, which is positive. And you can see here that they said that in line with the group's progressive dividend policy, the board is proposing a 20% year-on-year increase in the final dividend, which is fantastic. So yeah, a massive hike in that dividend from there. And the outlook didn't have too much detail, but they said they are positioned to still grow at pretty good rates going forward. And when we look at the business here, you can see that analysts are predicting that the growth will from here be a little bit more positive, although there's only one analyst. But here, you've got a company that has massively increased the revenue. Profit is up and generates good amounts of profit, really good profit margins. Financial health-wise, it's solid. There's no debt on there. It sits a lot on cash, on a lot of cash, which obviously it returns to shareholders. Obviously, one thing that I think that's going to be is through hiking that dividend up as well. And the owners still have plenty of skin in the game as well. So yeah, it's a company I'm slightly down on, but I haven't given up on this business because I think it still has, good balance sheet, good growth, makes good amounts of cash, and will return that through to shareholders, which it did yesterday. So yeah, I did buy a little bit of this one for the first time for a little bit. So yeah, hope you enjoyed the video talking about these 4 stocks that I bought. Let me know what you've been buying in the comment section, and I'll see you on the next video. Have a great weekend.